All right, let's get right into it. We are tackling one of the biggest questions for any investor trying to figure out 2025. Where should you put your money? We're going to look at that classic showdown, the tangible security of real estate versus the dynamic power of the stock market, to see which one really makes more sense in the here and now. Let's do this.
And man, 2025 is really turning out to be a roller coaster, isn't it? We're all trying to navigate this complex mix of policy changes, inflation that just won't quit, and global tensions that have the markets completely on edge. You know, the VIX, which is basically the stock market's fear gauge, it actually spiked above 50 earlier this year. That's a number that signals some serious, and I mean serious, investor anxiety. So the question is more pressing than ever. Where do you park your cash?
And that really brings us to our two heavyweights. In one corner, you've got real estate, the classic you can see it and touch it investment that screams stability and steady income. And in the other corner, you have the stock market, the absolute powerhouse of growth. But, it comes with its own special brand of volatility. It's the timeless battle of stability versus growth. And believe me, in 2025, the stakes feel higher than ever. Okay, so let's kick off with round one and make the case for property. In a world full of digital assets and wild market swings, there's just something comforting about owning a physical, tangible asset. But here's the thing, not all real estate is created equal. It is absolutely crucial to understand the two main categories here. So, residential property, that's what most of us think of, right? Single-family homes, maybe a duplex, up to 4 units. You can finance these with a normal, conventional loan. But commercial property, that's a whole different animal. We're talking office buildings, retail spaces, apartment buildings with 5 or more units, and these require specialized commercial loans. That line between 4 and 5 units, it changes everything. And look, the numbers on this chart really tell the story. You can see right away that commercial properties typically dish out much higher rental yields. We're talking in that 7 to 12% range. And check out the lease duration, 3 to 10 years for commercial versus just a single year for residential. What does that mean? It means a way more stable and predictable stream of cash flow. But there's a catch, and it's a big one, the barrier to entry. Yep, that's the catch. You're often going to need a down payment of 20 to 40% to even get in the commercial game. Think about it. For a $500,000 property, that could be $100,000, maybe even $200,000 upfront. That's a huge capital commitment that just puts it out of reach for a lot of people, which is what makes residential, with its down payments as low as 3%, a much more accessible path for most. So, why even consider real estate in this crazy climate? Well, because it can play a key defensive role in your strategy. It's a classic hedge against inflation, it's historically been less volatile than stocks, and it provides that steady passive income. And here's the key, it offers what financial folks call non-correlative returns. In simple terms, that just means its value doesn't always go up and down in lockstep with the stock market. That can be a really powerful balancing act on your portfolio. All right, time for round 2. Let's make the case for stocks. If real estate is all about stability, the stock market is where you go for that potential for explosive growth. But you guessed it, in 2025, that engine is facing some pretty serious headwinds. We have to be real about the risks here. Right now, the S&P 500 is trading at valuations that are giving analysts major flashbacks to the dot-com bubble of the late 90s. And on top of that, the market is incredibly top-heavy. The top 10 companies now make up almost 39% of the entire index. Think about that. When so much of the market's fate rests on just a handful of giant companies, that introduces a very unique kind of risk. But, and this is a huge but, here's where the story gets really interesting. While all those dot-com bubble comparisons sound terrifying, some experts are looking back at the late 90s and they're not seeing a warning sign. They're seeing a potential roadmap for what could happen next. And this quote from Morgan Stanley just nails that sentiment. The argument goes like this. The massive commercial adoption of artificial intelligence could unleash a productivity boom, kind of like what the internet did 25 years ago. Now, this isn't just about a few tech stocks getting a bump. It's about AI improving profit margins for all sorts of companies across tons of different industries, and that could be the fuel for the next big market rally. So how in the world do you invest in a market like this? Well, what everyone seems to be saying is that this is not the time for blind speculation. Instead, the smart play seems to be focusing on quality. What does that mean? It means hunting for companies with rock-solid balance sheets, a proven track record of consistent cash flow, and something called pricing power.
the ability to raise prices to protect their profits from inflation. And as always, diversification is still your best friend when it comes to defending against those out-of-the-blue shocks. But hold on, this whole debate isn't just a two-horse race between real estate and stocks. There's a third contender that's been on the sidelines for years, but is suddenly making a huge comeback. Bonds. I know, for a long time they offered next to nothing in returns, but that has changed. Big time. And that is the exact question that bonds are here to answer. See, while real estate can hedge against inflation, bonds have historically played a different but just as vital role. They are the classic hedge against a growth shock. That's when the economy suddenly slows down and sends stocks into a nosedive. I mean, just look at the track record here. See how 10-year treasuries performed during some of the biggest stock market crashes we've seen? During the dot-com bust or the tech wreck, they returned a positive 39%. During the global financial crisis, positive 17%. Even during that lightning-fast COVID crash, they were up 7%. It's like they say, when stocks zag, high-quality bonds have a proven history of zigging. So what's so different in 2025? It's that bonds are finally paying you for that protection. For years, yields were so ridiculously low that any little rise in interest rates would just kill your returns. But today, with much higher starting yields, bonds provide a pretty significant income cushion. They are, once again, actually compensating investors for the risk they're taking. Phew! Okay, so we've looked at the tangible appeal of real estate, the growth engine of stocks, and the defensive power of bonds. Now it's time to bring it all home. How do you take all this information and actually build your own strategy? And honestly, this is the most important takeaway of all. There is no single magic answer. There is no winner in the great debate between real estate and stocks. The best portfolio isn't about picking one over the other. It's about building a mix that is perfectly tailored to your personal financial situation and your goals. So here's a super simple 3-step framework to help you think this through. First, assess your capital. How much can you actually invest up front? Do you have that 20% for commercial property, or are you starting with an amount that's a better fit for stocks or maybe a REIT? Second, define your risk tolerance. Be honest with yourself. Are you okay with the ups and downs of the stock market for that shot at higher growth, or does the idea of stable rental income help you sleep better at night? And third, what's your time horizon? If you're investing for decades, an illiquid asset like real estate can make a lot of sense. But if your timeline is shorter, the liquidity of stocks and bonds might be a better fit. So in the end, the question isn't just about balancing growth and stability. It's about asking yourself, what is each asset's job in my portfolio? Is its job to hedge against inflation, to protect me from a downturn, or to capture the next big wave of innovation? The right answer, as always, depends entirely on you.